Many people wish to be able to live off of their investments. Not having to work for a living or withdraw money from your investments would be the pinnacle of financial freedom. Although it is a pipe dream, with the right combination of time and discipline, it is also a realistic possibility. In today's video, we'll go over all of the details surrounding the topic of investing for dividends and eventually living off dividend ETFs. Watch the video until the end and subscribe for more such uploads. Here we begin. Let's start with what living off dividends means. When a company makes a profit, it can either reinvest in the business, hoping for growth, or distribute it to shareholders in the form of dividends. In reality, many businesses do both. They may reinvest the majority of profits back into the business while also paying dividends to shareholders. The majority of investors prioritize a secure retirement. As a result, many people's assets are concentrated in accounts designated for that purpose. However, living off your investments after you retire can be as difficult as saving for a comfortable retirement. The majority of withdrawal methods call for a combination of spending interest income from bonds and selling stock to make up the difference. The famous 4% rule in personal finance thrives on this fact. The 4% rule aims to provide a consistent stream of funds to retirees while also maintaining an account balance that allows funds to last for many years. What if there was another way to get 4% or more out of your portfolio without selling shares and reducing the principal? Investing in dividend-paying stocks, mutual funds, and exchange-traded funds is one way to boost your retirement income or ETFs. Over time, the cash flow generated by those dividend payments can supplement your Social Security and pension income. It may even provide all of the funds required to maintain your pre-retirement lifestyle. It is possible to live off dividends if you do a little planning. If you plan ahead of time, you can live off dividends. Dividend ETFs. Finding the best dividend stocks can be difficult. Furthermore, achieving adequate diversification is even more difficult for small investors. Fortunately, some ETFs implement dividend strategies on your behalf. Increased dividends ETFs invest in stocks that are expected to increase their dividends in the future. So if you need immediate income, high dividend yield ETFs are a better option. It's all about dividend growth. Stock dividends, unlike bond interest, tend to grow over time. That is one of the primary reasons why stocks should be included in the portfolios of all investors. Furthermore, historically, dividend growth has outpaced inflation. This fact can be used to create a portfolio that is solely for dividend income living for investors with a long time horizon. Using dividends to buy more stock in companies is a smart strategy for people who are still saving for retirement. As a result, they will receive more dividends and be able to purchase more shares. What if you are already retired? Compounding dividend income is very beneficial if you have a long time horizon. But what if you are close to the retirement? Then dividend growth combined with a slightly higher yield may be sufficient for these investors. First, retired investors who rely on dividends may want to increase their yield. High-yielding stocks and securities such as master limited partnerships, REITs, and preferred shares do not typically generate significant growth in distributions. But on the other hand, investing in them increases your current portfolio yield. Dividends paid in a Roth IRA are not subject to income tax. Nonetheless, retired investors should not avoid traditional dividend growth stocks such as Procter & Gamble or PG. These stocks will increase dividend income or at above the inflation rate and contribute to future power income. Getting started with a dividend retirement portfolio. The funds you set aside for dividend investing can be spread across individual stocks and mutual funds. Dividend-paying mutual funds and exchange-traded funds or ETFs provide low fees, immediate diversification, and simplicity. Funds are typically set-it-and-forget-it investments. However, fund investors give up a valuable advantage: control. Most mutual funds hold dozens, hundreds, or thousands of stocks. For example, Vanguard's High Dividend Yield or ETF or VYM owns over 400 companies. Some of these are good companies with safe dividends, while others are of lower quality and will see their dividends cut during the next downturn. Some procedure high yields, while others produce very little income. Simply put, a fund is a collection of companies that may or may not match your personal income needs and risk tolerance, especially when the tide is out. Because it was not focused on dividend safety, Vanguard's high dividend yield or ETF got into trouble during the 2007 to 09 financial crisis. During this time, the ETF's dividend income fell by 25% and took 4 years to recover to a new high. Most funds also pay variable dividends, which fluctuate unpredictably from month to month, making it difficult to predict how much income you'll earn in any given month. While these are not necessarily reasons to avoid funds, handpicking your own dividend stocks can make it easier to adjust the level of risk in your portfolio and provide you with greater visibility into your income stream. Choosing your own holdings with a focus on dividend safety can also provide higher and faster growing income than most funds. You will also gain a better understanding of all your investments, allowing you to weather the next downturn with greater confidence. How much money you need to retire on dividends? To establish a reasonable range for how much you need to invest in living off dividends, multiply the annual dividend income you wish to generate by 22 and 28. Multiplying these figures results in a portfolio dividend yield or annual dividend income divided by portfolio market value of 3.5% to 4.5%. We believe you can build a conservative dividend portfolio within that dividend yield range without sacrificing business quality, income security, or sector diversification. Over time, we expect this portfolio to deliver mid-single-digit annual dividend growth. What are some of the common pitfalls to avoid? Dividend strategies can create the temptation to invest primarily in high-yielding stocks, which provide higher income today but are concentrated in a few industries, such as real estate investment trusts or REITs, master limited partnerships or MLPs, and utilities. A portfolio that bets heavily on these market areas without proper diversification may be more sensitive to rising interest rates, be hit harder by any industry-specific adverse developments, and generate total returns that deviate significantly from the broader market. And outside of dividend-paying industries such as REITs and MLPs, high yields can indicate that something is structurally wrong with a company or that the dividend needs to be cut to help the company survive. These circumstances can lead to a permanent loss of capital. Besides chasing yield, dividend investors can also fall into the trap of hindsight bias. The desire to own consistent dividend growers had led to the popularity of groups of stocks such as the S&P 500 Dividend Aristocrats among investors. Dividend aristocrats are S&P 500 stocks that have increased their dividends for at least 25 years in a row. These stocks get the attention of dividend investors because they have outperformed the market. We believe they will always pay and grow their dividends, but this is not guaranteed. Finally, dividend investors can fall into the trap of focusing on income return rather than total return, income and price return. Just because a stable company pays a dividend doesn't make it a better investment or more resistant to stock market price drops. In theory, it shouldn't matter whether your retirement cash flow comes from dividend income, bonds, or the sale of your portfolio's holdings. However, from a behavioral standpoint, leaving the principal alone and living off the monthly dividends can help investors tune out the noise caused by fluctuating stock prices. Furthermore, suppose the stock market experiences a significant correction during the early years of retirement. In that case, dividend investors are less vulnerable to the sequence of return risks because they do not need to sell more shares in response to lower stock prices. While most portfolio withdrawal methods involve combining asset sales with bond interest income, there is another way to meet the critical 4 percentage point rule. Both young and old investors can benefit from the stock's compounding and historically inflation-beating distribution growth by investing in quality dividend stocks with rising payouts. All it takes is a little forethought. Investors can live off their dividend payments. Let us know your views in the comments section below, and make sure to subscribe for more such videos.